Risk is an inherent part of investing. After all, no one can control the losses or gains of a particular asset, sector, or market. But you can manage your risk by diversifying your portfolio. Here's a look at what diversification is, why it matters, and how you can incorporate it in your investment strategy. Diversification is a technique that reduces risk and volatility in your investment portfolio. The idea is to invest across various asset classes, industries, and categories in an effort to reduce losses if a particular investment does poorly. Have you ever heard the saying, "Don't put your eggs all in one basket"? If you have all your eggs in one basket and the basket falls, you can get ugly really quick. Think of each investment class as a different basket. A diversified portfolio could have a dozen baskets, with each basket representing a different class of assets. You never know which basket will have the best or the worst year. You try to have some money in each since no one can predict the future. Different types of assets come with varying levels of risk. For example, stocks have high growth potential and are relatively volatile, while bonds tend to offer less growth but are generally less risky. You can strengthen your approach by diversifying within asset classes. You may want to buy stocks and companies across sectors, such as technology, industrials, or consumer staples. You may also consider buying companies of different sizes and across the globe. Mutual funds, exchange-traded funds, otherwise known as ETFs, and index funds are other options, especially if the thought of selecting a diverse mix of investments yourself sounds intimidating. Mutual funds allow you to pool your money with other investors in a collective fund that is invested in a pre-selected mix of assets. These can include stocks, bonds, commodities, and other securities. Index funds and ETFs are similar to mutual funds in that they hold a diverse basket of investments. However, they are managed differently. Mutual funds are typically managed by a professional portfolio manager who actively selects securities to invest in with the goal of beating the market. This is what is referred to as active management. Now, diversification does not eliminate risk or prevent investment losses entirely, but it can hedge against potential downturns by ensuring your portfolio includes investments that continue to grow while others may be declining. If you have any questions, we'd love to continue the conversation.